Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. This is our live Q&A every Thursday at 11. You know, as long as I'm not solving chess puzzles or doing something else, I'm usually here. If you're in the chat, just give me a thumbs up so you can hear me and see me, and we will get started. As I wait for that thumbs up, a couple of administrative items to make this run smoothly, hopefully. The first is, if you're going to ask a question in the chat or you have a topic you want me to cover, please, I see the thumbs up. Thanks, Fast Eddie 333. Please tag me in the comment. Shows up bright orange, because if not, I'm going to just skip by it. So that's the first thing. The second thing is, when we're done, 2 hours from now. By the way, I love the folks. I get these comments after every live Q&A. Someone sees the video like the next day, and their only comment is, I'm not gonna spend 2 hours. And they don't realize that I've got timestamps below the video, because they don't watch the first couple of minutes to see that I say, hey, I'm gonna have timestamps below the video. So I will have timestamps. It takes me a couple hours. Certainly by the end of the day, I'll have timestamps to each of the topics or questions we talk about. And so, that'll be in there. And yeah, that's it. So what I'm going to do, I'm going to start with a number of questions and topics that have been sent to me over the past week or two. And then I'm going to jump into the chat and try to answer all of your questions. I dropped in the chat a link to a Morningstar article that I would say I've perused, but that actually means to read very carefully. I have not perused it. I've skimmed it. The idea is that the 4% rule, according to Morningstar, might now be the 3.3% rule. I'm not sure I agree with that. One thing I'll note is I'm pretty sure they use Monte Carlo analysis, which is just a tool that can generate hundreds or thousands of scenarios. By scenarios, I mean inflation and S&P 500 return and bond return, or whatever other factors you want to put into it, other asset classes, and it'll just spew out any number of combinations of possible scenarios and test the portfolio to see if it lasts 30 years. Again, assuming a certain percent you take out in year one adjusted for inflation, and that's perfectly fine. I think it's a useful thing to do. But it's very different than what Bill Bengen did. He's the father of the 4% rule. He used historical data. He used actual inflation data, actual S&P 500 returns, actual, in his case, intermediate term treasuries. And so what's the difference? Well, a couple of things. First of all, when you're using historical data, obviously, you're limited to what's actually happened in the past. And we all know that while the future might be similar, it's probably not going to be identical. So that's a limitation. With Monte Carlo analysis, you're going to get all kinds of scenarios, including, I would add, some that are probably really unlikely to ever happen. I mean, you can get some really oddball combinations in terms of sequences. And so that can be good because, again, you're not limited by historical data. But it can also be not so good because it can generate scenarios that are just really unlikely. Of course, it's going to generate hundreds, maybe thousands of scenarios that are very likely, right? But here's the real takeaway. I think it's wrong to use Monte Carlo analysis to conclude that the 4% rule, based on historical data, is no longer valid. They're two different things. They can both be useful. Take them for what you think they're worth. Anyway, I put that in the chat, a link to that article. And the other thing I'll mention, there was an interesting discussion. I do read what you guys say about me in the chat, before the show starts. I can see it. And there was a talk about what other good shows do you watch on financial information. I think some mentioned the Money Guy show, which is a good show. Anyway, there was this point that, whoever you watch, listen to in a podcast, read a blog, you have to keep in mind it's our opinions. Now, I try to do my best to explain why I believe what I believe. But at the end of the day, you got to make your own decisions. And you may disagree with me. You may disagree with me frequently. That's okay. I promise I won't lose any sleep because you guys disagree with me. Or maybe you agree with some things. But the real thing is you got to make your own, your own decisions. I hope you find the content useful. Even if you disagree with it, I find content that I disagree with, I find often very useful because it helps me further understand my own views and why I believe what I believe. All right. Okay. Enough chit chat. So I'm going to cover a number of topics, as I said, and then we'll get into the questions you guys are starting to ask me in the chat. And the first one is actually about credit cards. This will be quick. I've had a number of questions about credit cards. The first one has to do with the Bank of America Preferred Rewards card, which is a card I carry. And let me show you, let's see if we get this to work. So I don't know if I can make this any bigger. This is the page. This is a Bank of America page. This is the card. This is my now primary go-to everyday card. I put pretty much everything on here except Amazon and Whole Food purchases because I have the Amazon Prime card, which is 5% cash back. And if you qualify for, let's see where it is. Here it is, Platinum Honors. So you got to have a Bank of America checking account, and you got to have at least 100 grand either in the bank or in their investment platform or a combination. So I just moved over an IRA, and that qualifies me for this. So I'm getting like 2.62% on every purchase, and then for some purchases I'm getting 3.5. It's a great everyday card, but again, you got to have that. You got to have a certain amount of money in the bank. There's been a lot of talk because you see there's three levels here: gold preferred, platinum preferred, and then platinum honors preferred. They're adding 2 new tiers, and I'm going to show you what they look like, although this image is not really good. This is from the Flyer Talk site, and it's kind of blurry. It's the best I could do, but you can see here gold, platinum, and platinum honors. Those are the 3 we know about. They're going to add, I don't know if they've actually announced this officially, but diamond and diamond honors. And the concern was, as you can see, diamond requires $1 million and diamond honors requires $10 million. So that's a lot of walking around money. And the concern was platinum honors would no longer offer this, I don't know if you can see it very well here, but a 75% bonus on credit card rewards, which is how you get to the 2.6 and 3.5 reward rates. But as you can see, at least according to this image, platinum honors is going to stay the same. The thing that diamond and diamond honors will get you, it appears, is some reduced rates down here on mortgages and home equities. That seems to be the only big difference. We're actually going to talk more about brokers in this show in response to a question that I got unrelated to credit cards. But so that's my take. I think if you're a platinum honors member, at least so far, I think our 75% bonus on credit cards is protected. So that's good. I've been getting, blah, blah, blah. Let me try that again. I've received a lot of questions about the M1 Finance credit card. I'm actually going to do a video reviewing this thing. It'll be a week or two. But let me show you the card. Here it is. I don't have this card. I don't know if I'm going to get it. Probably I won't. I don't know yet. Probably I won't. But I think it could be a decent card for some folks. Depending on your reward strategy. The basic idea is if you invest in some of these companies in your M1 account, then you'll get elevated cashback rewards up to 10%. I don't know if you can read that here. And if you go to the site, it's just m1finance.com/how it works with hyphens /credit. You'll see the list. In fact, I can show it to you here. Just click this fancy button and here's the list. So here's the 10% cashback companies, which is obviously a huge cashback rate, but the question is how much do you spend at all of these places, of course. And then there's 5%, 2.5%, and then everything else gets 1.5%. But the one thing to keep in mind here is one thing I can tell you right now is that, let's see, where is it? Well, I can just tell you what it is. You're limited to $200 a month in cashback. You can't go over $200 a month in cashback. And to get it, you got to be a member of M1 Plus, which costs $125 a year. It's free the first year. It gets you some other things. Obviously, if you're using the card and you're getting $200 cash back a month, if you can max it that way, then the $125 a year would be worth it, and it might be worth carrying it. But I'll do a more detailed review. I haven't decided yet if I just think it's too gimmicky. That's the question for me, And I don't like the idea of investing in companies just to get an elevated cashback reward. I don't know. To me, it's a little bit of a gamification that I don't like, but maybe I'm just being ridiculous. I don't know. All right. The third thing, real quick, and then we're going to move on. Capital One's come out with a new card. I've actually got a link to this card below the video. This one's actually interesting. It's called Venture X. So they've got their venture line of cards. I carried the venture card for a long time. And so the basic idea is you get 100,000 miles bonus if you spend 10 grand in the first 6 months. That's worth $1,000 when used for travel. So it's $1,000 sign up bonus potentially. You get some other things, of course, but I'll come back to the annual fee in a minute. But the basic reward rate is you get 2x on everything, but you get 5x on when you book flights through Capital One. So this is a new thing. This was never sort of a focus for the standard venture card. But if you book through Capital One, you get 5x on flights and 10x on hotels and rental cars. So what they're trying to do basically is compete with Chase Sapphire Reserve, and we'll see how they do. One thing that's interesting is their annual fee of $395 is obviously a lot less than the Sapphire Reserve's $550, although it's more than the Sapphire Preferred's $95, which I think is a good card as well. But the interesting thing here is you get $300 in travel credits, so that takes away almost all of the annual fee, and you get 10,000 bonus miles and every anniversary, which if it's used for travel, that's $100. So that wipes out your annual fee right there. And there's a limited time offer on a vacation rental credit for $200. So it's not a bad card if you're looking for a travel card. I haven't done the math yet to compare it to Reserve and Chase Sapphire Reserve and Preferred, but I think it's interesting. So I thought I'd share that with you very quickly. My credit card rewards balance, I actually looked it up in M1 Finance, but I'm sure they've signed me out. I can sign back in. It's around 32 grand. I have some money I need to put into it from last month. It's kind of been hanging in there around 32,000. So that's not bad. I got that going for me. All right. Enough about credit cards. Let's get to the barbell retirement strategy. So this was a big question. I've received it many, many times, and I was confused by it because I'm familiar with the barbell investment strategy. It's pretty simple. You basically have two assets. You have very safe assets. You can think cash even. And then you have very risky assets. Think, I don't know, your QQQ or even your TQQQ, some leveraged investment. And the idea is, you'll kill it in the very risky investment over time. That's the theory, I guess. But of course, it's very volatile. But that's okay. You've got this safe investment, and so they just call it a barbell. I'll show you. I'll actually see if I can get this working. So, like remember the old barbells where you had, this was like in the Gold's Gym image or something, or I don't know, cartoon. So you have your safe assets over here, right, and you have your risk over here. Right. That's why they call it a barbell, whatever. But I wasn't familiar with the barbell retirement strategy. And but a lot of folks clued me in. And so it comes from Heritage Wealth Planning. This is, I don't know why I've stopped it right here, but this is another YouTube channel. And he does a lot of he talks a lot about, this is, by the way, Josh Scandlin. I don't know much about Josh. This was the video I watched to understand what the barbell retirement strategy is. I thought he did a great job explaining it. And it's effectively a combination of the barbell investment strategy and the bucket strategy of retirement. So you probably can already tell, since I'm not a fan of the bucket strategy, I've got some concerns with the barbell retirement strategy, and I'm going to walk through them. But that's basically what it is. And it relates to a question that I received that I want to read briefly. I thought it was a good question. It comes from a listener named Haas. Don't know if Haas is in the chat or watching, but in any event, he says, hello and thank you for all you do for us. Would you please consider this question on your next streaming event? I feel like I've asked this, but I still find with all that I watch and read, I still don't know the answer. I understand your bucket approach concerns and understand your rebalance approach and how it allows you to buy low and sell high. Question, why wouldn't we use the bucket strategy and rebalance to tackle a market downturn? That's a basic question. And he had some other sort of related questions, but that's basically the question. And it's a good one. So let me first sort of walk through how the barbell strategy works. There might be a way to combine the two, but it's kind of tricky For those of you that are listening and you're saying, Rob, I have no idea what in the world you're talking about. With a bucket strategy, the idea is when you get to retirement, I've seen it more in the 3-bucket strategy. We're going to look at a 2-bucket today, but 3 buckets. You have cash, maybe for a year or two worth of expenses, fixed income for, let's just say, 5 years of expenses, and then the rest in stocks. And the idea is if stocks drop, you leave your stock bucket alone. You just spend your cash down. And if we're in a really bad market and there's more bad years, then you can start spending the fixed income. But between the two, you've got in this hypothetical 2 years of cash, let's say 5 years of fixed income, you've got 7 years of cushion. And that feels right to me. And in fact, when I retired now 3 years ago, of course, I ended up not, but that's what I was going to do. It was the implementation of it that ended up convincing me that it's difficult to implement and unnecessary. Now, others have different views. Not only Josh from Heritage Wealth Planning, but Christina Benz from Morningstar. She loves the bucket strategy. So you have to understand this is my take on it. And so let me kind of show you how this works. And what I'm going to do is I'm going to go back to the whiteboard and I'm going to use the hypothetical that Josh used. And by the way, he's got a number of videos on this. I only watched the one. So there may be other aspects to this that I don't appreciate, but he assumed a $400,000 portfolio and a withdrawal rate or withdrawal each year of 20,000, which is 5%, right? And he didn't adjust for inflation in his analysis, and that's fine for our purposes. So what he said was, we want 5 years over here in this safe. We want 5 years. So we need 20,000 years. So that's 100 grand. So we're going to put 100 grand in basically cash. He said, I think cash, CDs, or he mentioned mortgage-backed securities, which I didn't really understand that, but he just said, this is safe. Let's leave it in cash. And he just assumed, yeah, you're going to earn a little bit, but we're just going to assume zero. All right. No return on this part of the portfolio. And then, of course, the other 300 grand goes over here. And I think, although I don't know that he explicitly said this, but based on the returns he was using, it was S&P 500, right? And what he wanted to do was sort of stress test this. He wanted to say, okay, let's begin in 2000, because as we know, 2000 was an ugly year. In fact, I can show you 2000, maybe briefly. I know this is like a mess of numbers, all this. 2000 is right here. You probably can't see it. We lost 9% in 2000. We lost almost 12% in 2001, almost 22% in 2002. That was the dot-com tech bubble bursting, and it was ugly. So I think it's great that he picks that. You want to stress test these sort of strategies in like one of the worst possible environments to retire in, and certainly, this would qualify. So what he did, he has another rule here. He says, okay, and this is the problem with the bucket strategy. Conceptually, it's fine to say we'll spend down the 100 grand if the market's down, but it still raises the question, well, but when do we refill the bucket over here? When do we take stocks and put it, in this case, into cash? So what he said was, look, if the market is up, right, you're going to take from the stocks. And if the market is down, you're going to take from the cash bucket. That's his sort of withdrawal approach. And that seems sensible, right? And one of the ideas is we don't want to spend down the stocks in a down market. We don't want to take more out of stocks, when let me see if I can put, there we go. Oops. And here, no, I can't do it. Never mind. We don't want to spend down the stocks in a down market. Now, I've said, yes, that's true, but we can just rebalance every year, and that should more or less take care of it, because if stocks are way down, wouldn't we be selling fixed income to buy the stocks? That's been my take. And so here's what was interesting about his approach. He kind of went through real quick 2000, 2001, and 2002. Those were the 3 bad years. And because they were all down years, we took our spending from the cash bucket. So if we come down to the end of 2002, this part of the barbell is down to 40K, right? We've taken out 20,000 3 times. And this one, because of the down market, I think he said, I'm just going by memory here, I think he said isn't that a terrible circle? Anyway, it doesn't matter. I think it was down to 187. All right. Now, in 2003, the market was up just over 28%. So in 2003, it was up 28%. And so what I was expecting him to do was to take from the stock bucket. But he didn't actually do that. I mean, yes, this bucket was up, and I don't remember the exact number, but we'll call it, it's up to 250. That's roughly correct. But he said, no, we should still take from this bucket. So this goes down to 20,000. And I guess the reason, even though the market was up this year, I guess the reason is because we're still not back to the 300. But see, this is where things start to get kind of difficult, because after the fifth year, we still weren't back up to 300. So now what do we do? And what he said was, well, we really don't want to, we'd probably be too uncomfortable going below the 20,000. So in that fifth year, he had us taking from this bucket. And that's my problem with the bucket strategy. We get into those sorts of calls. I don't know how you do that without market timing. I mean, you're retired, your emotions are involved, and you're seeing your portfolio go down. Yeah, you had 3 bad years. Thank God we've had a couple of good years, but you're still not even back to where you started. And it just, I just don't trust myself to make smart calls about that. And that's the problem with the bucket strategy. We could add a third bucket. It doesn't solve the problem. We're still left with, when do we finally take money out of our stock bucket? That's the question. Do we wait till we get all the way back up, in this case, to 300,000? That might take a decade. In fact, in this case, we couldn't wait that long. We would have run out of cash if that was the rule. And so that's one of my concerns with this approach. The other approach, or the other concern, is he put $100,000 in cash. That's 25% of the portfolio, effectively earning nothing. To me, that's a big, big problem. Now, he may very well say, look, if you want to put in intermediate term bond funds, that's fine. He may be perfectly fine with that. I don't know. All I know is the example he used. He had 25% in cash. And let me just show you, and by the way, if you take my approach and you rebalance every year, for those first few years, you still end up selling stocks, even though the stocks are down so much. You say, well, Rob, I thought by rebalancing we would avoid that. Well, you can have some combination of scenarios where, no, you end up being sort of a net seller of stocks by rebalancing. The reason you would in this case, though, is because you have 25% in your portfolio that's earning absolutely nothing. If you put that money in, say, intermediate term treasuries and rebalanced, you wouldn't be a net seller of stocks. And I ran all of the numbers. I won't, just for the sake of time, I won't go through them all here, but I will show you in Portfolio Visualizer. And let me, I'll bring this up in just a second. We're going to look at, we'll use asset allocation, I guess. So here's Portfolio Visualizer, and we're going to look at 2000 to 2009. So that's a decade. And we'll just start with 10. Well, actually, you know what we'll do? Well, no, I just want to leave it at 10,000 for a moment. And we're not going to withdraw any, because what I want to look at is returns. So we can look at the S&P 500, basically US large cap. We can look at, they actually have cash. So I have 100% cash portfolio. Again, I'm just wanting to see the returns of these assets to show you, I think, a pretty important point. And then we're going to look at intermediate term treasuries, which is where I would have most of my safe bucket, and we'll analyze the portfolio. So let's just think about this. We're 2000 to 2009. So 2000, 01, 02, terrible years. We'll look at it here. 08, horrible year. So a lot of bad times. But you look at the returns. I'm not even so much interested in compound annual growth rate, although this is interesting. US large caps returned a negative compound annual growth rate of 1%. Intermediate term treasuries over that decade, 6.7%. So that's why I cringe at you renegades out there that say I'm 100% stocks, particularly in retirement. Good luck and Godspeed. In any event, the thing I want to show you is look at these returns. Cash actually returned 5.99, which isn't bad. This was in 2000. But intermediate term treasuries returned 14%, right? They did exactly what we want them to do. Stocks were down, treasuries were up. Same thing here. Cash returned 3.7 in 01. That's not bad, but treasuries returned more than twice that. 7 point, or not quite twice that, I guess. No, more than twice. 7.55. In 02, cash was 1.65. Intermediate term treasuries were 14.15%. And in fact, if we get rid of cash for a moment and just stick with treasuries and US large cap, and we go all the way back to 1972 and then all the way forward to 2021, and we compare these two, obviously large cap's going to significantly outperform intermediate term treasuries. But look how they behave. And I know this may be a little hard to see. I can make it maybe a little bigger. In years where the blue line is the S&P 500, in years where it's down, 1973, it was down 16%, 4.5. In 74, U.S. large cap was down 27%, but treasury, here's a more recent example, 2008. Of course, a bad year. Stocks were down 37%, but treasuries were up 13.3. So I know at the moment we're in unprecedented times in terms of interest rates and other things, but bonds are still important, particularly in retirement. Now, you might throw some tips in there to protect from inflation. We've talked about that in the past. But so at the end of the day, my concerns with the retirement the barbell retirement strategy. One is I think it's very difficult to implement because you get into the position. In fact, if you watch his video, he was struggling. What do we do? We're down to 40 grand in the cash account. This year, our stocks did go up, but they're still well below where we started. What do we do? He decided, I'll take from cash. Well, I just don't think we should be making the decisions that way. We should have rules and we should stick to them. And you can do that with the barbell strategy. You could just say, like he did at the beginning of the video, if the market's up, I take from stocks. If that year the market's down, I'll take from the cash fund. And others do something similar. Guyton Klinger, two guys that have done a lot of research on this, have some withdrawal strategies that are much more complicated than that, but kind of do the same thing, just with multiple asset classes. But it gets really convoluted. So that's my first concern. And that's not even a concern specifically with the barbell retirement strategy. That's just my concern with the bucket strategy in general. And I don't think you need it, because if you've got bonds in there and you've got a well-diversified portfolio, if stocks are really down, in most cases, there could be exceptions depending on the precise numbers. But I think in most cases, you're not going to end up being a net seller of stocks. Now, to Haas's question, I suppose you could combine these a little bit and say, look, I'm going to rebalance every year. But if it just so happens to be the case that rebalancing makes me a net seller of stocks, I'll stop at that point. I won't rebalance to where I'm actually selling stocks. And I say net seller of stocks, I mean after factoring in your withdrawals from the account for retirement. So you could maybe add that element. I would suspect that won't happen very often if you've got a well-diversified portfolio of stocks and bonds. If you're sitting on a pile of cash, which was the example in the video that I watched on this barbell retirement plan, yeah, that could be the problem. But I just wouldn't recommend 5 years of cash. So that was my second concern. I just think that's, it's certainly not what Bill Bengen did. Not that we got to do what he did. He was all intermediate term treasuries. But I just think 5 years, it's one thing to have 5 years of fixed income, which would include treasuries, right? But 5 years of cash, that's a big concern for me. So too much in cash. The portfolio itself, I think, lacks diversity. I don't want S&P 500 in cash and that's it. I'd prefer more diversity. And then I think it's just difficult to implement. By the way, in the video, we never got to the point where, when do we fill up the cash bucket again to 5 years of expenses, which would have really depleted the stocks? We never did that. And we weren't rebalancing. It just, to me, it's just not workable. So that's my take on it. I think he did a great job explaining it. As I mentioned, there are other videos that he's put out that may cover some of my concerns. So definitely check it out. Watch his videos if that's of interest to you. And but that's my take on that one. All right, got a couple more to go through. And this was an interesting question about employee stock purchase plans or company stock purchase plans, which I had back in the day. Comes from a listener named Kevin. He says, I have a company stock purchase plan at work, and I'm kind of skimming this. He currently puts 3% in. He gets which is standard, 15% discount. That's what I got when I was working at Bearing Point, which is now bankrupt, but it used to be a publicly traded company. And before it was Bearing Point, it was KPMG Consulting. He says the stock hasn't done anything in 12 years. I don't know where he works, by the way. It's not really important, but stock hasn't done anything in 12 years. So what he basically does, if I understand him, is he buys it, gets the discount, sells it as soon as he's able to, and then just puts it in a 3-fund portfolio. So all I can tell you is that's exactly what I did when I was at Bearing Point. Now, there were restrictions. Because I was in the legal department, there were restrictions on when I could sell. Maybe this is true for all employees. There were windows when you could sell. And I would just liquidate, and I would make the money because I'm getting a 15% discount. I think the company may have thrown in some matching. I don't remember. And I wouldn't necessarily. It depends on the company. I might be willing to take some risk if I really believed in the company in terms of an investment. I was not. I didn't. I was not a fan at the time in terms of holding long-term stock in the company I worked for. And if you want to avoid having that concentration of your assets, I did it again. So I think it's a reasonable approach. It's kind of a hassle, honestly, but you're getting that 15% discount, so you're making some money on it. Of course, you're paying taxes, and so you got to factor all that in and decide whether it's worth it. But all I can tell you, Kevin, is I don't know if it was the right approach. I think it was. But it was the approach. That's the approach I took. So seems reasonable to me. All right. Next question deals with TIPS, Treasury Inflation Protected Securities. It's a great question from Jan. Jan says, could you please explain total return when it comes to dividends and stocks and interest in bonds? And particularly wanted to understand it as it relates to TIPS. All right. So let's think about total return. Let's start with stocks. So, if a stock is trading at $100 over some period of time, it goes up to 110. It's gained $10. It's gained 10%, right? But what if it's paid a dividend? Because the dividend isn't reflected. Well, actually, it kind of is reflected in the price. But if it paid a $1 dividend, you won't see that by just looking at the price over, say, a period of 1 year. It paid you the dividend. Now, what did you do with that dividend? If you reinvested it back into the company, how would that actually work? And it can be automated, right? You don't actually have to do this. And it can work with ETFs and mutual funds as well. It's the same idea. The company would pay you the dollar per share you own, right? That would go into your, say, brokerage account. And then your broker would automatically buy, and they can do fractional shares with all of this, $1 worth of the stock. Who are they buying it from? This is important. They're not buying it from the company, at least not explicitly. I suppose if the company's buying back its stock, which many companies are right now, it could happen to be that you're selling it to the company, but you're selling it. You're buying it from an investor, right? And so, but that reinvestment doesn't change the stock price, right? It just gives you a little bit more in shares, a fractional amount, because we're talking about small dollars, right? And so when you want to look at your total returns, you want to make sure you're looking at data that shows reinvested dividends. And let me give you an example. I'm going to go back to this crazy screen right here, which I know is just a mess of numbers, and you probably can't make heads or tails out of it. But this comes from New York University, their business school. And this column right here, and by the way, if you just Google NYU historical returns on stocks, you'll get this page. You can download it as a spreadsheet. I can make it a little bigger here maybe and focus in on one thing. There we go. So this is S&P 500, and it includes the dividends. So they're assuming these would be your returns each year starting in 1928 if you reinvested the dividends. So let's scroll down and look at something more recent. Remember, we were looking at 2000 just a minute ago with the barbell strategy. So we lost 9.03%. Including dividends. If we took dividends out, we said, well, don't include dividends. What would happen to this number? Well, since this is a negative number, it would become even more negative, right? And in fact, I can give you an example of that. If we Google S&P 500 returns by year, one of the first is macro trends. Here it is. I'll show it to you. This is macro trends. And it's got by year along with an ad. Get rid of that. See if I can make it bigger. There we go. And if we go to 2000, remember over here, 2000 was a minus 9.03, right? Negative 9%, 9.03. Here, 2000 is a negative 10.14. Well, who's right, who's wrong? Well, they both are. It's just that this is basing it just on price. It's not factoring in the reinvestment of dividends. All right. So when you factor in reinvestment of dividends, your losses, if in a down year, will be a little less because you get the benefit of the dividends, and in an up year, it'll be a little higher because you get the benefit of the dividends. Tips and bond funds generally work in a similar way. You can reinvest the interest or not. And if you reinvest the interest, then you're going to have over time, as you earn interest on interest, greater and greater returns. Now, you could take that interest, by the way, and still benefit from compounding by taking the interest and investing it in something else. Right? You don't have to invest it in the stock or fund that paid the dividend or the interest. I think for retirement accounts, most of the time, that's just what we do. We set the dividend or interest. We automatically reinvest it. That's what I do for retirement accounts. And we can look at an example, maybe. Yeah, let's look at an example for tips. I hope, Jan, you find this helpful. I wish I can't get really direct feedback. I can go into the chat when I'm done, but you guys might be saying, Rob, I'm totally lost. I have no idea what's happening. I hope that's not the case. Anyway, this is Vanguard Inflation Protected Securities, VIPSX, it's a mutual fund. We can look at the portfolio for a minute. It's, I think, intermediate term. Yeah, it's got a duration of 7 years. And if we actually go to the quote page and look at the yield over the last year, trailing 12 months, it's 4%. So if you take all the interest it's paid, divide it by its price, and I don't know, let's see, looks like it's as of basically yesterday. I don't know how often they update this, but that's how they do it. What interest is it paid divided by the price? That's the yield. But if we go to performance, you see different numbers. Year to date, it's 6%. Last year, it was 10, almost 11%. Why is that? Well, first of all, these numbers include the reinvestment of that interest. And of course, also, bonds earn money not just with interest, but there can be capital gains because the value of the bonds go up. For example, if interest rates go down. Tips are a little different, though, because they can also go up as inflation goes up higher than expected, right? Because if they're going to take inflation and adjust the principal amount of the bond by the rate of inflation, and then they're going to take whatever the interest rate is and apply it to that, hopefully, a higher amount. So I hope that helps. But the difference is, again, you could take your interest out and you won't get the benefit of the compounding from the interest portion of your return, or you can reinvest it, I think, which probably most people do, back in this case, to a tips fund, and you'll start to earn interest on interest. And when you look at Morningstar data, there may be some exceptions, but everything I've read from Morningstar says that they assume a reinvestment of dividends for stocks and a reinvestment for interest on bonds. You just have to remember, not everyone does it that way. So, like, for example, we looked at that other site where they weren't including dividends in their S&P 500 returns. So there you go. And by the way, with Portfolio Visualizer, you can set it. Let's see here. Yeah. Right here, I don't know how well you can see that. You can set it to reinvest dividends or not. I usually leave that on, even when I'm looking at retirement, on the theory that I'm just going to keep reinvesting dividends, and then at the end of the year, this is particularly true in a retirement account, I'll just pull out my money. But why not reinvest whatever dividends or interest have been paid along the way? Again, in a taxable account, since dividends and interest are already going to be taxable income, I wouldn't automatically reinvest those. Okay, hope that helps. Is anyone still watching? There's a few of you. Good. All right. I've got 3 more, and then I'm going to turn to the chat. This is a good one. This comes from Matt, and I'll just summarize the email. What he says is, look, well, I'll read part of it. Love your YouTube channel and nerding out with you on all things retirement savings and investing. Thank you. I would be so grateful if you would do a video on getting back into bonds. Here's what he says. Before the pandemic and the Fed's massive intervention, I believed the market was overvalued and due for a correction, and moved all of my 401k and IRA savings into cash. And then he says, to wait for the inevitable correction. I know. Market timing is a fool's game. I'm wiser now. So he started dollar cost averaging back into stocks. His basic question is, what in the world do I do with bonds? Do I just go into bonds? I mean, interest rates are so low. Is this the right time to be doing that? And I've had various forms of this question, and pardon me while I drink some coffee. And I've said I'm sort of a lump sum person. I can understand, particularly now, the dollar cost averaging if it makes you feel comfortable. I would just set up and probably put it in writing what I'm going to do, over 6 months, 12 months, whatever. But for me, at the end of the day, and I've been thinking a lot about this, and I interviewed Peter Maluk, who is of creative planning. He's done some books with Tony Robbins. I was talking to him yesterday, kind of about this very topic. And he and I sort of are of the same mind that at the end of the day, for me personally, I'm just going to lump sum it. That's what I do. Yes, it could turn out not to be as good if the market crashes, but long term, I'm not a good market timer. I personally don't think anyone is. And I even did some things. It wasn't huge for my portfolio, but I did convert some tips into basically money market funds. And that was a mistake. I shouldn't have done that. Now, it wasn't a huge amount. At the end of the day, I haven't calculated it. I doubt it did much of anything to my portfolio. But from a philosophy perspective, that was a big no-no. Shouldn't have done that. I like intermediate term treasuries and tips, probably 50-50. Is it the only way to go? No. You can use investment grade corporate bonds, fine. But to me, that's sort of the sweet spot. Now, and I'm not going to dollar cost average in. In fact, I'm going to making a few things, sort of rebalancing my portfolio. And when I do, I'm just going to do it all at one time. That's my approach. I think whatever you do, though, you should be consistent. It should be written down. It should. The thing is, if you write it down, you got a plan. Then it helps you. It does two things. Hopefully, it helps you ignore the market and trying to time the market. But if it doesn't do that, at least it lets you know when you're market timing. Because if you're not following the plan, you got to have a hard conversation with yourself. Why am I not following the plan? I set it up 3 months ago. I was going to dollar cost average for 12 months. Why am I having concerns now? So yeah, I can't tell you guys what to do. You got to make your own best decision. But for me, Matt, I'm just sticking with my asset allocation, putting it all in. I can tell you, I've had countless folks through emails, through this channel, people that I know, come to me and say they profoundly regret market timing. They were trying to be safe, whatever. They took money out in 08, 09, whatever. I've yet to have someone come to me and say, 15 years ago, I just lump summed it all and I just deeply regret it. I've never had that happen yet. Maybe they're out there. So that's my approach. All right, 2 more questions. This one comes from Royce, and it was a response to that. I did a video on kind of how to keep your online accounts safe. And one of the things I suggested was you not put all of your retirement money in one brokerage account. Obviously, when you're just starting out, or maybe you've got one 401k, it's all going to be in one place. But let's say you're, in your 50s, 60s, older, and you've got, you've saved a fair amount from retirement. A lot of it's in IRAs, and you have choices, and some is in a taxable account. My view was I'm uncomfortable keeping it all in one broker. And so Royce wanted to know, okay, what's your take on brokers? What do you like, in terms of which brokers to use? And so I'll give you my very high level. Let me do a video on this, diving into more details. But here is my take on it. First of all, what brokers am I using now, or have I used in the past? You ready? Scott Trade doesn't exist anymore. Vanguard, Fidelity, Merrill Edge, M1 Finance, Betterment, Wealthfront, Transamerica, ADP for a 401k. I think that's it. Now you might say, well, which ones are you using now? And I'm not going to tell you, other than M1 Finance. I've got my credit card rewards there. Here's my take on it. First of all, some things that I would consider in picking in making a choice. One is, what kind of investor are you? Do you want your money in mutual funds and you just want one mutual fund family? You just want Schwab, or you just want Fidelity or Vanguard or whatever? Because if you are, it probably makes sense. You might not you might want to divide it up into more than one broker for security, but presumably least one of your accounts is going to be in the mutual fund family you want, if that's the case. If it's ETFs, doesn't matter, it's different, because the problem with mutual funds is if you're at Fidelity and you want a Vanguard fund, you may be paying some money to buy it. It may not be a big deal, depends how often you're buying and selling, but could be. But so the type of investor, or are you an active trader? If you're a day trader, which I'm not, have never been, that's a whole different kind of analysis. I'm going to assume for retirement, we're not day trading. But, what kind of investor are you? The second thing to consider is what kind of automated services do you want? Do you want a service like, say, a Betterment where they rebalance for you automatically? Of course, most of the brokers have similar services. Vanguard has investment advisory services, both digital and human beings involved, right? And there are funds that can do this. A Wellington fund, a lot of people talk about. In fact, I'll come back to Wellington in a second if I remember. It's a balanced fund. So in a way, it's kind of doing it for you if you're comfortable putting all of your money in one mutual fund. You could use a life strategy fund. So there are different ways to get these sort of automated services. But do you want that? Do you have a lot in a taxable account and you either want tax loss harvesting or you want direct indexing, think of direct indexing as rather than buying the S&P 500, you take, maybe 100 of those companies that represent the S&P 500 and invest directly into each one of those, so that if one of them falls, it gives you two potential benefits. You can get some tax loss harvesting, not at the fund level, like S&P 500, but at the individual stock level. You could also, in theory, separate them. Have your dividend payers in a retirement account to shield the dividends from taxes, and have the non-dividend payers in a taxable account. And you might say, okay, that is, who does that? That's no one does it. You have services that do it. Personal Capital does it. I think Wealthfront does it. I'm sure there are others. But, do you want those automated services? That's the second sort of thing I would think about. The third thing I think about is my wife. And how hard is this going to be for her to manage if I get hit by a truck? So I think about those things. I mean, not often, mainly when a truck goes by. Anyway, seriously, I think about how do I want to, structure my portfolio, our portfolio, so that my wife, can handle things. The fourth thing, this is particularly true for retirement folks, is cash management. Some firms are just better at offering credit cards if you want that, and bank accounts as part of the one broker firm. Fidelity offers bank accounts. Schwab does. Vanguard doesn't. I will tell you, when it comes to all of these sorts of services, by and large, Vanguard is not top of my list. Love their funds, love Vanguard, but they don't have a lot of this stuff. So which ones do I like? If I were going to pick an automated investment service, I would probably put Betterment at the top. Yes, Wealthfront's good. Yes, you could do Vanguard digital advisory services. The list could go on and on. But particularly for those folks in retirement, Betterment offers a lot of services. I like their user interface. They've gotten a lot better. I mean, you can actually now, they used to sort of force you into their group of ETFs. You could set the stock bond allocation, but you were sort of forced into their group of ETFs, which didn't include REITs, didn't include commodities, which may be important to you. You can now add those on your own. So they've really added a lot. So I like Betterment. Sort of, if you want to sort of an all-in-one broker, I know we talked about splitting it up among multiple firms, but if we just sort of break it down to one, I like Fidelity. They've got a Fidelity Visa card. They got great cash management accounts. You can write checks. You could use Fidelity without a bank account. And of course, they've got great index funds. So I think Fidelity is a good one. If you're in the accumulation phase and you want an IRA, I still really think M1 Finance is cool. There are no fees, unlike other sort of robo-advisors, like, Betterment's 25 basis points or 40 basis points if you want access to an advisor. You don't have that with M1 Finance, but you don't have those extra fees. You pay the underlying fees of the ETF, but you can click a button to rebalance it automatically. It's cheap. I like it. And then the fourth one I'll mention, this would be sort of, I mentioned an all-in-one kind of place would be Fidelity. But if for high net worth, and, I don't know what that means, someone with lots of money, I don't know. It could be retirees with, a million or two or 10. I really like Schwab. Schwab has, they have all of the bank stuff. I think they have credit cards too. I think they have an Amex, if I remember correctly. But in any event, their services are excellent. If you're into borrowing, not investing on margin, but borrowing that's secured by some of your assets, they have pledged asset line, and the interest rates get really cheap depending on how much you have. But you got to have a lot. So I think Schwab is excellent. If I had to pick just one, I could only use one. I personally would probably pick Schwab. Um, so that's my high level take. There are lots of other good ones that I haven't even mentioned. Interactive brokers, there's a lot of, TD Ameritrade. There's a lot of good options, but that's my take on it. All right, last question before we go to the chat. And this was actually from the chat last week, and I did a lousy job answering it. Kind of like the barbell retirement strategy. That was from the chat last week as well. I'm not sure if I did a good job answering it this week, but I tried. This one has to do with NUSI, which is a fund we'll look at, XRMI, which is another fund, and QRMI. So let's take a look at these. The question is, are these good bond alternatives? Are these good alternatives to bonds? That's what we're going to try to figure out. And here's the first one, NUSI, Nationwide Risk Management Income. And if we go to the quote page, you can see its 12-month yield is 7.69%. So you can get an idea of why one might look at this as a possible bond alternative. Global X, I'll explain what these funds do in a minute, but I just want to kind of give you a high level. And I'm going to use this one as an example. This one, this one doesn't have a 12-month yield because it's literally 2 months old. Same with this one, NASDAQ 100 risk managed. If we go to the quote page, it probably doesn't have a trailing 12-month. All right, it doesn't, but we're still going to use these and we'll look at them. So what's going on here? What these funds do, they implement a collar strategy. So, and I'm not an options trader. I don't trade options. I think for most people, you have no business buying and selling options. You have some small part of your portfolio and you think it's fun, that's fine. But I generally think most options traders, at least folks like you and me, end up worse off. I know that's a controversial view. I know some of you trade options. That's just my opinion. So what does this do? So it takes an S&P 500 and it sells call options and it buys puts. So the idea is on the call, you're selling someone the right, but not the obligation to buy let's just think of it as an S&P 500 index, your shares of an S&P 500 ETF at a predetermined price. And that option is going to expire. It's not going to last forever. These are probably short dated options. I'm guessing they're probably every month. Every 4 weeks is my guess. I didn't dive into the prospectus to figure that out. But by the way, just so you know, I'm not making this up, here it is. This is the S&P 500 risk management. Oops, there we go. You can see right here, I'll make it a little bigger. They sell calls. They generate an alternative source of income by selling covered calls, right? And now there's several risks to covered calls, but one of them is, what if the S&P drops? You got no downside protection. Well, not to worry. That's why we get the collar. We got one on both sides. We got the covered call on one side, and we got puts, protective puts right there. They buy protective puts, which gives the fund the right to sell their shares to the seller of the put at a predetermined price. So if it falls below the strike price, they make money on the puts. And so the basic idea behind all of these funds is to use these options really to generate income. Because of the options, you're not going to, you're not, if the S&P 500 takes off, you're not going to get the benefit of that because of the call, right? Of course, on the other hand, if it falls a significant amount, you're not going to get hurt because of the put. But the problem is why I don't think these are good bond alternatives. And I'll show you why, even though we have very little data on these. Let me pull it up. Yeah, here we go. So this is, again, Portfolio Visualizer. I used NUSI, which is this one, the Nationwide Risk Management Fund. I used it because the other two, we'll look at one of them, XRMI in a second, but they've got like 2 months of data. This one's only got like a year and a half. but I compared it to the bond fund, BND, which is Vanguard's intermediate term bond fund. And we can see, again, we're only looking at from January. It's all the data I've got. What can I tell you? January 2020. You can see that nationwide, it actually outperformed the bond fund by a little bit, right? Actually by a lot for just 2 years. But look at its standard deviation. It's 12.75 versus 4. The purpose of bonds is to protect your portfolio, to have diversification from stocks, and to give your portfolio some cushion, to take some of the volatility out of it. And that's the problem with these funds. They don't do it. They give you volatility. Now that 12.75 isn't as bad, isn't as high as the S&P 500, but it's definitely obviously 3 times the volatility of a bond fund. We can add in XRMI, and I think we get 2 months of data or 1 month, hardly anything, but it does make a point. Yeah, September and October, so whatever, that's what we got. But again, standard deviation for nationwide, 15.5. Standard deviation for global X, S&P 500 risk management, 11%. And here we are with our bond fund at 2.65% standard deviation. So yeah, I really don't think these are good bond alternatives at all. And given their standard deviation, my hunch is over the long term, they're not going to outperform the S&P 500. There's just no way. And so if you're going to take that kind of risk, why not just put it in S&P 500? That's my view. But time will tell, and I could be wrong. So there we are. Those are the things I had prepared. Now I'm going to jump to the chat. If you joined late and you want to ask me a question or want me to discuss a topic, tag me in your comment. If you've already put in a comment with a question and you didn't tag me, just repeat it again. That's fine. But I'm only going to look at the chat if I'm tagged, which means if you want to say something nasty about me, just don't tag me, and I won't see it. Salty, I think this is in reference to the Morningstar article that said the 4% rule is now the 3.3% rule. He says, you didn't catch the caveat, quote, and a 90% probability of success. That is a high likelihood of not running out of funds over the time horizon. Well, actually, I did catch that, Salty. I didn't mention it, but that's what tells you that it's a Monte Carlo analysis, right? Because that's what they're doing. They're putting a 90% probability of success. If you look at historical data, see, Bingen didn't have to deal with probability of success. What he said was, I want 100% success. Well, you would have to have very extreme circumstances to get that in a Monte Carlo situation, yeah, because they give you just such wildly outlier scenarios. But with Bingen, he was looking at historical data, and he just said, okay, effectively what he said was, how much could I take out in year one for each year, 1926 to 1976, and not run out of money for 30 years? Well, each year is different because the markets were different, and some years it was as high as 10%. And he didn't write his paper this way, but he just said, okay, what are the percentages for each year? Okay, which one was the worst? 1966, I think. Some say it was 68. He didn't actually identify it, I don't think, in the paper. But whatever, 1966, that was 4, is actually like 4.1%. There we go. That's what we're going to use. So he didn't have to worry about this probability of success thing. But yeah, that's the Monte Carlo analysis. Yeah. So Matt said, I emailed you a few days ago looking forward to hearing your answer to my question, which I think I did answer that today, Matt. I don't know if it was satisfactory. If you have a follow-up, love to hear it. Throw it in the chat. Robert, who's got a really good name, says, my 403B combines Roth and pre-tax contributions together. Okay. Should I put future Roth contributions in a separate fund in an effort to keep Roth money separate from pre-tax money? Okay, Robert, that seems to me to be impossible, like not legal. Now, I could be wrong. I'm not a 401k, or in this case, 403b plan administrator expert. They've got to have records keeping traditional and Roth separate. They've got to. So I would suggest you call them. I mean, maybe it has to do with how it's shown to you, like online when you log in. But it would really, I just don't even know how legally the plan could do that. It's got to follow all the IRS guidelines. Again, I'm not a plan administrator expert at all. but I really find it hard to believe that they don't keep those separate. I will tell you, in my case, and I have 401k, not a 403b, I contribute to a Roth 401k, but the company, and I'm not contributing anymore, but long story, but they match. They give me a matching contribution. Well, at the moment, all matching contributions go in traditional. They don't go into Roth because they're not taxed, right? Roth is only money that's been taxed, right? But the contributions aren't taxed, so they have to go into a traditional. But when I log in, I can see the two. Here's the Roth, here's the traditional. They're separate. And when I roll over, which I did not long ago, into a IRA, I had to open up two IRAs, a rollover IRA for the matching contributions and a Roth IRA for the Roth 401k. You say, wait a minute, Rob, you said a rollover IRA, right? Well, why isn't it a Roth rollover IRA? I don't know. They don't call them that. They just call them Roth. There is a difference between a rollover IRA and an IRA. And if you're rolling over from a 401k, I always put that, unless it's a Roth, into a rollover IRA. You get some extra protections from creditors. Not that that's my concern, but I mean, why not take it? But also, if you ever want to transfer it into a 401k at some future employer, they don't all allow it, but those that do pretty much only allow you to put in rollover IRA money. In any event, I know that's not what you asked, Matt, but Robert. I would be really surprised if they don't have record keeping on that. So I would call them and ask them. So Mike says there are more sophisticated return models such as EGARCH, which I have no idea what that is. Oh, I can't even pronounce those words. Okay, well, you've given me something to research, Mike. Exponential, general, autoregressive, conditional. That's got to be something else. Is that right? I don't know. I guess it is. Oh, and there's even one from NYU. Why does this seem medical to me? I guess it's math. I was an English major, Mike. You guys, when you ask me questions, keep that in mind. So thanks a lot, Mike. Now you've given me something. I'll spend hours figuring this out. I could be doing chess puzzles. Instead, I'll be doing that. No idea what that is. Mark, where were you on your retirement investment journey when you decided to go all in on low index funds? So I was pretty early. In fact, yeah. So I started investing in the 401k at my law firm in 1993, and I didn't know what I was doing. I don't even remember what I invested in, but I'm sure it wasn't index funds. And I also, in the taxable account, was investing in Legg Mason Value Trust, which was Bill Miller's fund. He beat the S&P 500 for 15 years before it cratered and then blew up. It was during that time, before it cratered, I don't remember, I don't know what caused this. I mean, I was just reading. I know one of the early books I read, I don't know what year it was published. Let me look it up. It's Rick Ferry's All About Asset Allocation, which is a book I really like. I don't know what year he published it. But that was one of the early books. That's 2010. I wonder if there was an earlier version. In any event, I would say it was around 2000, the early 2000s, when what I decided was the day is going to come when Bill Miller's not going to beat the S&P 500. I'd concluded that. I didn't know when it would happen. And then the question was, am I going to hold on? Am I going to feel comfortable holding on? Or am I going to question, and then bail? And so that's when it was. That's sort of what triggered my thinking. And I pretty much went all into low-cost index funds. Somewhere I would say between 2000 and 2005. Be my best guess. Salty, can you review again the Amex Blue Cash card, which is dramatic? What's dramatic, Salty, the card or my review? Because my review could be very dramatic. I don't know how. Sure, we can look at it. So I'll pull it up on the screen here once I get it up to the screen. Here it is. A couple things to keep in mind. So it's a cashback credit card. It does have a fee. It's $95. It's right now they're offering a 0 intro fee. So the first year it's free, but then it's $95. You get a they call it a welcome bonus. They don't call it a sign up bonus. It's a welcome bonus. $350. Now, if you go to their page, and I can leave a link at the end of when I'm done with the video to information on this card. But depending on you might actually see a different welcome bonus. Amex is sort of famous for that, where I don't know how they do it, but two people could go to the same page and see a different welcome bonus. But in any event, this is showing us $350. You got to spend $3,000 in the first 6 months to get that. And then in terms of the cash back, you get 6% on groceries, but it's limited to $6,000 a year. So that may or may not be a big deal for you, depending on how big your family is, how much you spend at grocery stores. You get 6% back on streaming, which is excellent if you stream a lot, Netflix and I don't know, Disney and whatever. You get 3% cash back on transit, so ride shares and whatnot. And you get 3% back on US gas stations, and you get 1% on other purchases. So overall, it's a strong cashback card. I think the issue is, and you have to do a little bit of math, but I think for most people, if you only wanted to carry one credit card, you would be better off with a card that pays 2% cash back. Because, you have these big numbers here, 6%, 3%, and so on. But I think most people, you spend a ton of money in this 1% category. And losing effectively 1% that you could be getting with a 2% card, I think for a lot of people actually makes this card, again, if you only want one credit card, not the best. The card I like the best now, I don't carry this card because I have Bank of America, which by the way would be my number one everyday card if you qualify for platinum, preferred, honors, whatever they call it. But a good card, if you don't bank at Bank of America, or don't keep that much money in Bank of America, is Wells Fargo's Active Cash Card. Here it is. You get 2% cash back on everything. They have a $200 sign-up bonus. You got to spend $1,000 in the first 3 months, but it's 2% on everything. So, one approach would be to carry both cards, right? Use Amex Blue Cash Preferred for obviously the purchase categories that get you the elevated cash back. And then for everything else, you'd use this card. We kind of do that, except again, the cards we use are Bank of America and then Amazon Prime. So that's our approach, but this would be a good approach too. And Blue Cash Preferred is an excellent card. All right. Sometimes I think I know more than I should about credit cards. I don't know. I don't think my mom is proud. Okay. Interesting question from 365, vacay. So I think that means they vacation 365 days a year. I don't know what they do on the leap year, but for every other year, it's vacations 24/7. The question, the majority of my investments, 90%, that's in parentheses, are in standard brokerage accounts. Is there any advantage to opening a Roth IRA for the last couple of years before I retire, or is it worth the hassle? I think it is. You have to keep in mind, if this is your first Roth IRA, you can always, and you start putting money in, you can always take the contributions out penalty and tax-free because it's a Roth. You've already paid the taxes on it, right? But for the earnings, you got to wait 5 years, and that's true even if you're 59 and a half on this 5-year rule, because because the theory is they want you to use this for long-term savings, but you can only put in there, what's the number going up to next year? Let's see here. IRA, I know it just changed, right? Or they just announced it. Is it $7,000? I don't even remember. Yeah, $7,000 for 2022. Plus, if you're 50 or better, another $1,000. All right. You're going to have your money last you. Obviously, if you're 65, let's say, you plan on a 30-year retirement. Just looking at my hair, it's kind of a mess. Anyway, you could satisfy the 5-year rule. It wouldn't be a problem. And once you satisfy it, it's satisfied for good. This is different, by the way, than the 5-year rule on Roth conversions. That's totally separate. It's a different rule. Why not? It grows tax free, and you take it out tax free. I think it's worth it. I'm putting money in Roths right now. Roth 401k. I have to look at the Roth IRA. So yeah, I personally think it's worth it with all those caveats. James says, how do you feel about the ETF DRIV? Well, I have no idea. I'm going to guess maybe an electric vehicle. I don't know, DRIV? I have no idea. Let's see. Let's look it up. Autonomous and electric vehicles. Nailed it. That wasn't that hard, I know. I don't know a thing about it. We're going to pull it up on the screen. We can all learn something. Let me finish the question. Second, I want to thank you. Bought book, funded my Roth fully, switched my 403b to target date fund, Fidelity 2040, open a taxable brokerage this year. Love it. All right, so let's get to DRIV. I guess that's what we'll call it. Here it is in Morningstar. Global X autonomous and electric vehicles. So let's look at, so it's 61% US, and then of course there's a lot of companies outside the US, particularly in China. We'll see what we can look at. Its Chinese, its exposure to companies in China, if we want. But here it is. This is interesting. The fund's PE is only 16. That kind of surprises me. By the way, so just so we're all on the same page with Morningstar, you can search for DRIV. Just go to the little hourglass and click it, and you can search. I'm in the portfolio tab here. We can come over to quote and get some high-level info about this ETF. This doesn't surprise me. Very low yield because most of these companies aren't paying a dividend, right? They're reinvesting all of their cash flow. Expensive, well, moderately expensive, 68 basis points. Anyway, so let's come back over to portfolio. And I wanted to see what companies it invests in. So it's got 77 holdings. You can see that right there. No surprise, Tesla is the number one holding. Although I didn't expect, I didn't expect this. NVIDIA, Microsoft, Alphabet, I don't understand. Well, Google, which is Alphabet, I guess is in the autonomous driving business. I didn't know Microsoft was. Apple, we don't know if Apple is or not. They are, they're not, they're hiring, they're firing. I don't know what they're doing. They just don't shouldn't take their eye off the ball of like continuing the cash juggernaut that they are. Anyway, this actually, well, Ford obviously makes sense. I guess General Electric in some way is in the EV and the autonomous vehicle business. So anyway, that's sort of the fund. So I guess it depends. If you're a big believer that here's the problem, is that I believe that autonomous vehicles are our future. I also believe electric vehicles are our future. Let's just assume I'm right. I know that's a big assumption. I'm asking a lot of you, but let's just assume I'm right. That doesn't make this a good investment. I'm not saying it's a bad one, but the problem is there's going to be a lot of losers in that business. Warren Buffett did a great job on this with the car industry. There were thousands and thousands and thousands of car companies. He did this at the last Berkshire Hathaway meeting where he showed, it was like just the car companies from like the early part of last century that like begin with the letter S. I forget, it was one of the letters. And it was just pages and pages. Obviously, we know now which ones, stayed around. But back then, you didn't know. It's kind of like cryptocurrencies. We have no idea which cryptos are going to end up being the winners, however we define that. But they're certainly not all going to win. Same thing with electric vehicles. Right now, Tesla, obviously the big player, I think, both in electric vehicles and autonomous driving. But I suspect if we fast forward 10 years, certainly 20, autonomous driving is going to be a commodity. It's just going to happen, right? I mean, all the car companies will make them. They'll all work. That's my belief. And we're all going to have for electric cars that can go 500 miles more. I don't know. I mean, and so I don't know who the winners are going to be. So I personally, even if I wanted to take a gamble on electric vehicles, I'm not sure I would use this fund because of all of the other companies that are in it. I would probably want to be more focused with just car companies. Of course, the problem with that is, how do you know which ones are going to be the winners? Their valuations are sky high. So I probably just wouldn't take this approach to investing at all. But if I were looking at this particular fund, that would be some of my concerns. It's kind of an odd fund because it's kind of like a mix of, I don't know, QQQ and cars, I guess, because you got Ford in there. I'm sure you've got General Motors. So I don't know. It just doesn't hit me. I could be wrong, but that's my take on it. I certainly, I tend to not invest in any of those sort of sector specific funds. I don't have any. I do have some sectors, like I've got Bank of America and Wells Fargo stock. Those are individual companies. So I do take some, I guess, risk that way. If I wanted to invest in the autonomous vehicle market, how would I do it? I don't know. To me, Tesla, just the valuations are just crazy. All right, another question. This one from Scott wants to know my thoughts on the ETF Meta. Is that ETF? Because there's a company now that sounds familiar, but I'm guessing this is different. There is an ETF with the ticker META. It's Roundhill Ball Metaverse ETF. How do you guys find this stuff? It's a US fund technology, 75 basis point expense ratio. Scott, I guess this is the fund you want me to look at. 300 million in assets, which is nothing. Pays zilch in dividends. Let's look at the portfolio. So we know it's going to be a growth, right? We know that because there's no dividends. I think it would be impossible, to have a value fund without dividends. I guess unless you were hedging stuff, I don't know. But in any event, obviously it's a growth fund, mainly US stocks. And coming down to portfolio, it's an interesting portfolio. I don't know what the logic is. Let me, sometimes to really understand a portfolio, maybe all the time, you want to go to the ETF page fund website itself. So here it is. This is Roundhill Investments. The Roundhill Ball Metaverse is designed to offer investors exposure to the metaverse by providing investment results that closely correspond, before fees and expenses, to the performance of the Ball Metaverse Index. I had no idea there was such a thing. Well, yeah. So I have two takes on this. I just don't get into. I just don't do this. That's one thing. I actually have three things. I just don't. I just keep I keep it simple. I keep my index fund sort of right down the middle of the road for the most part. The second thing is the metaverse. I guess this three-dimensional, we'll all be wearing goggles. I don't know. Could be a thing, right? I mean, it could end up being the next version of what we know of as the internet. And still, a lot of the companies in this fund could go belly up, right? Or significantly underperform. That's the one thing we have to keep in mind, is that a company can be incredibly popular and it can be a great company and it can be a terrible investment. The third thing is, if this, resonates with you, I've said this many times, and you've got like 5% of your portfolio and you want to put it into autonomous vehicles, or you want to put it into a metaverse fund, I would certainly, I don't think that's unreasonable. It's not what I do. I take mine and put a small portion into individual stocks. Some would say that's unreasonable. Some would say that's a big mistake. But those are interesting funds. Thanks for sharing them. I'll probably spend some more time looking into those once I get over the math problem that I've got to figure out later today. Brennan says, Rob, what are your thoughts on the future of the Roth ladder strategy? Do you think it will be viable path in the future? So the Roth ladder strategy, so I kind of alluded to this actually when we're talking about the Roth, because I mentioned the 5-year rule doesn't that I was talking about that applies when you open your first Roth IRA, doesn't apply to conversions. Conversions are different. With conversions, you take money from a traditional IRA, you convert it to a Roth. That starts a 5-year clock. Different though. This is the conversion clock, and you got to wait out 5 years. And it helps to understand the rationale behind it. If I have a traditional and I'm not 59 and a half, let's say I'm 50, and I want to take the money out, I said, look, I know I'm going to pay my taxes, but I really hate paying that 10% penalty, which I'll have to pay. You think, well, wait a minute. I don't think I have to pay that for a Roth. So here's what I'll do. I'll convert it first to a Roth, which will trigger the taxes. That's fine. I knew I was going to pay them. I'll get it into the Roth, and then I'll take it out right away, and I'll avoid the 10% penalty. The IRS says, haha, we thought about that. No, we're going to hit you with 10% penalty. And if you want to avoid that 10% penalty, you got to wait 5 years. So the idea is for the latter, particularly for early retirees, is all right, I'll retire, say when I'm 50. Maybe I've got some taxable accounts that I can live on, but I'll start my tax rate went way down because I'm no longer working, right? Or maybe I'm working part-time, but my tax bracket's low. It's a great time to do a Roth conversion. So I'll convert enough to live on for 1 year in year one of retirement that I can't spend for 5 years, right? And then in year two, I'll do the same thing. That goes out another 5 years because the clock on the 5-year rule on conversions applies to each and every conversion. The 5-year rule that applies to opening up a Roth IRA applies only once to the very first one you open up. And once you satisfy that, you satisfy it for all for contributions. But we're talking about conversions. So in year three, you convert enough again for 1 year, and you do that for say 5 years. You can do it for longer. And then you can start spending that money effectively in year six. So it seems to me, Brennan, that as long as the tax rules and the rules on Roths don't change, yeah, it's still viable. Obviously, anything could change. Who knows what the future will hold in Washington? Man, I have no idea what they're going to do. But I don't know of any. I'm trying to think if there's any proposals right now that would change that. I don't think so. I don't know. There could be. Uh, Another question. I liked your video on passwords and security. As all your wealth is in online accounts, isn't it safer to distribute our investments equally among multiple brokerage accounts, say 6 to 8? Well, that was kind of one of the points I made in the video. I don't know that I would do 6 to 8. I mean, you've got to balance security with managing all of this. But yeah, I'm not comfortable keeping it in one. That's for sure. I don't know what the magic number is. 2 or 3 is my guess. I don't know. Maybe you've got $100 million, and maybe 6 to 8 makes sense. But for most of us, you could do that. I mean, I'm not saying not to do it. Well, I'm not telling any of you what to do. Just giving you my opinions. 6 to 8 just would be a little hard to manage for me. But yeah, I do like the idea of not keeping it in one. All right. Michael says, watching from the start at 1.5 speed. See if you can catch up before it ends, LOL. Did you get that? Do you see what I did there? Watching from the start at 1.5 speed. See if I catch up before it ends, LOL. Okay. How long are we into it? It's only been an hour and 24 minutes. We got 12 hours to go. Just kidding. All right. Oh, another 712 portfolio question. All right, I'm going to move this up. I'll even do an article on this because I've gotten tons of questions about this. So I will do it. This is from Ethan. So it's tips, cash, large cap US, mid cap US, small cap US, non-US stocks, emerging markets, REITs. Wait a minute. Natural resources, and then commodities is separate. U.S. bonds, international bonds, divided equally, 8.33% each. Um, so I'll do a video and an article on this. I will. Just reading it through, that's about 25% bonds, right? Because you got TIPS, US bonds, international bonds, 8.33% each. It's 25%, right? And then 75% in what I would call stocks, includes natural resources and commodities. My hunch is it's probably not a bad portfolio. I'm not a huge commodities person in terms of allocating to that specific asset class. Obviously, an exposure to the S&P 500 gives you lots of exposure to commodities, right? Think Exxon, Deere. I mean, but this actually doesn't strike me as a bad portfolio. Why do they call it 712? I'm reading, by the way. Bear with me. Here, this is what I'm reading. I just want to understand the name. The 7 of 712 represents the suggested number of asset classes to include in your portfolio. The 12 represents the 12 underlying investments. Ah, okay. So here are the asset classes, and here are the 12 underlying investments. All right. I wonder, let me just pull up Portfolio Visualizer for a moment. Do they have as a pre-programmed option the 712? I don't think they do. Okay. So it's on my list. I will do a separate video on that, Ethan. Interesting. All right. Maxwell. I am currently going to college, working in branch at JPM Chase, and living at home rent-free. After saving and 401k contributions, I have $400 a month. Any investment strategy for that? So first of all, Maxwell, I talked to someone recently who in college they ended up working at a credit union. And it never occurred to me when I was in college to go to a bank and try to get a job. And I wish I would have. It'd have been a lot of fun. I'd have been perfect for that job. I'd love to have been a teller. But this person was a teller. Then they were an officer. They did mortgage lending and underwriting stuff. And it was just great experience. They learned a ton about money. The bank put them through personal finance class. They taught in-house. I don't know if all banks do that, and he ended up he's now a real estate investor. And I think it's a great job. So, we've talked a lot about this on the show. I think a good starting point is just your 3-fund portfolio. If you're, young, you might say, I don't even want bonds. That's okay. A lot of volatility, so you just got to be prepared for that. So you could do the 3-fund portfolio or a 2-fund portfolio. If I were literally starting out, $400 a month, I'd probably just put it in the S&P 500 to start with. And then I might, assuming if it's a 401k, you could slice and dice it. So I could maybe put 80% in the S&P 500, 20% in whatever international index fund your 401k offers, something like that. Again, don't get wedded to 80-20. It could be 70-30. If someone said, I just want S&P 500 to start with, I think that would be fine too. And that's my philosophy. I know some people are no, this has got to be the portfolio, and that's just not, I don't agree with that. I think there's a lot of reasonable things you can do. I still like the 3-fund portfolio. You might just put 10% in a bond index fund, and 70% in an either S&P 500 index fund or total U.S. market index fund. I think both work, and then 20% in sort of an international index fund. I think that'd be a good way to go. It will be a bumpy ride. You just need to know that there'll be years when it's, going to be down. That's just life. So again, Maxwell, I'm not telling you what you should do. You got to, figure it out on your own, I suppose. But you asked my opinion. That's probably what I would do today if I were starting out from scratch. How I would invest my 401k, something like 70% U.S., 20% international, 10% bonds, probably something like that. Yeah, sounds about right. Okay, Joshua. How have you determined when it was time to look for another job? Any things you wish you would have done before making the change? A move for me will require a big pay cut, which adds stress. Well, Joshua, it's a great question. I'll just tell you my experiences. So I worked at Winston and Strawn. Winston and Strawn is a Chicago-based law firm. I was in the DC office. I was a summer associate, and then an associate, then a partner. I made partner, and 2 years later, I left. And the reason I left, there were a lot of reasons. The primary reason was, and this is just if you're not a lawyer, you've not worked in a big firm, you wouldn't know this. If you are, you'll know exactly what I'm talking about. The vast majority of associates never make partner. The vast majority, and when you do make partner, you become what they call an income partner. You're a partner, but you don't really share in the profits. You make a little more money. The raise actually wasn't significant when I made partner, because they have another level of partner called a capital or equity partner. And so most associates don't make income partner. Most income partners don't make capital partner, just the nature of the beast. You make capital partner by bringing in a lot of business. So when I made partner and I looked around at the partners, both income and capital, that had been around a long time, I put them into two categories. Now, this is in Washington, D.C. It could be very different where other people are. The income partners tended to be partners that sort of grew up within the firm like I had and didn't have a lot of business. I had some, but not a lot. The capital partners, there were exceptions to this. They either developed a specialty, they were patent litigators or whatever, or they came from the government. They were former U.S. attorneys, assistant U.S. attorneys. They worked at justice. They had all this trial experience, and they could bring in business because of that experience. And I didn't have that. And I looked at the partners that grew up in the firm like I had, and I didn't like what I saw. I thought, I don't want to be doing that 10 years from now, and I don't want to do one thing my whole life. So like you are considering, I took a 6-figure pay cut, took a big pay cut, and I don't regret it one bit. I left that job because I concluded there was no future for me at Bearing Point, a conclusion that turned out to be correct. And I got probably my favorite job. I really liked Winston and Strawn, but I worked at the Public Company Accounting Oversight Board. I took a pay cut to get that job. I was like in reverse. But that was a great job. I enjoyed it. I was in the enforcement division of the Public Company Accounting Oversight Board, which regulates the auditors of publicly traded companies. So there, the decision was this. I hadn't worked in auditing at all. This is going to be a totally new experience. I'm going to learn a lot. If I ever want to go back into private practice, I can do what I couldn't do before because I'll have all of this experience at the PCAOB, which is a very niche kind of legal practice, but in high demand when you're an auditor and the PCAOB decides to investigate you. And if there are any auditors listening, public auditors, the last thing you want is for your audit to be chosen for inspection, or worse, to get a document request from the PCAOB saying, yeah, we'd like to see your audit work papers. Thank you very much. That's not a good time. And I ended up, so the first, I guess the common element in all of this was I left because I wanted to experience different opportunities. I didn't want to be at a big firm all my career, and I didn't like necessarily my future prospects. So I went in-house, even though it didn't work out in the sense that I left a couple of years later. Great experience. I traveled the world. I handled KPMG Consulting's all of their technology litigation and all of their international litigation. So I had cases in Brazil, Australia, Israel, Ireland, Germany. I was in Sweden. I was in France. It was a lot of fun. And then I took the PCAOB job because I love numbers. I love investing. It was perfect. I'm reading 10Ks, 10Qs, audit work papers. I got to sort of combine my love of finance and investing in public companies with my legal practice. So even though I took a pay cut, it was a great opportunity. And eventually my income went up. You get raises, here and there. And then I actually went back to Winston and Strawn. And that decision was, when I've got all this experience at the PCAOB, I can actually bring in business. But my work with my websites and my online business, which I was doing, just proved to be more alluring to me than big law. That's a long-winded question. Is anyone still watching this show? Okay, Joshua, I don't know if that helped you, but that's my experience. I thought long term. What am I going to enjoy? What am I going to learn from? Am I going to get new experiences? That's what I went with. All right, Josh says, he says, good morning, Rob. Mid 2020, I changed my bond allocation from SWAGX SWRSX. What are the pros and cons of being all tips? Should I allocate at least a portion back to SwagX? So I'm guessing SWRSX is tips. I'll pull it up for everyone to see. Yes, it is. So here's the tips fund that he's in now. Good fund, low expense ratio. It's an intermediate term tips fund. You can tell that because the effective duration is 7.7. You can also tell it because of this little box here with the black dot. We can go to the portfolio and see it a little bigger. And the other one, the other fund is aggregate bonds. So I'm guessing this is similar to like a BND. 4 bips. Yeah, effective duration is 6.51. Its portfolio is probably a mix, I'm guessing. But I could be wrong. No, it's a mix. So this is like Vanguard's BND. Government bonds, corporates, and securitized, which I'm guessing is mortgage-backed securities. So it's a great question. The position I like the best, and I learned this from David Swenson, who passed, I've mentioned him in the past. He passed away maybe a year ago, but he ran Yale's endowment. He's written a book, Unconventional Success, I think it was called. I've got it lying around here somewhere. His view was, take your bond portfolio. His sort of starting point was 70% stocks, 30% bonds, but whatever. So for the bonds, he would say, okay, take half of it, put it in treasuries, like intermediate term treasuries, and the other half in tips. Now, you could use a bond fund like this Schwab, I think. So it has some treasuries, but it also has some investment grade corporate bonds. It's got some mortgage-backed securities. I think that's fine. I personally like his approach. Half in that kind of fund. So if I were using those two funds, again, Josh, I'm not telling you what to do. You got to make your own decision, but you asked my opinion. I would put half and half in each. And the idea is if inflation turns out to be much higher than we thought, the tips fund will pay off. If it's not, the other fund will pay off. So I'm not really making a bet on inflation, right? Yeah, I mean, if you think about tips, if you own tips, let me see if I can bring something up very quick. Here we go. I'll show this to you in just a second. Bear with me. Let's see if I can find it. Maybe I can't. Is this it? That's going to take me too long to find. If you look at tips and treasuries and like the latest auctions, which was what I was trying to find, and I can't find it in Treasury Direct, for like a 5-year bond, the interest rate, the coupon rate, is going to be higher on a treasury, right? And that's because they work differently. With a treasury, whatever interest rate you get, that's what you get. With a tip, they're going to change the principal balance by the inflation rate. So go up or down. You'll never, if you hold it to maturity, it'll never go below. But with inflation, it goes up, and then whatever your interest rate doesn't change. With an I bond, your interest rate changes. But with tips, the interest rate doesn't change. But if there's inflation, the principal balance of the bond goes up, and whatever your interest rate is, I don't know why I'm holding these as fists, like I'm going to fight. Anyway, the interest rate gets applied to that higher balance, right? And so if you hold tips, you're like, come on, inflation, let's go. Let's hyperinflation. You want inflation because, well, at least as far as your tips investment. Maybe in life you don't want hyperinflation, but for your tips, bring on the inflation because the principal balance is just going to keep going up and up on your tips. If you have treasury, you're like, that's the last thing you want because your balance isn't changing, your interest rate's fixed, and inflation's eating away at all of this income that you're getting, which isn't much to begin with. And so that raises the question, well, okay, that's how they work. Which one should I use? Where's inflation going? And that's where I have absolutely no earthly idea. More importantly, I don't want to invest based on a prediction for inflation. So I like them both. I'd probably do both. 50-50 is what I would do. It's what David Swenson recommended, and that's where I learned it from, and it made sense to me. He used treasuries. I think, a fund like the Schwab fund or the Vanguard BND that includes some investment grade corporates and mortgage-backed securities. That's fine too. All right. Mike says 90% of my portfolio is in a rollover IRA invested in a 3-fund portfolio. 65%, I'm reading these tickers, pretty sure that's total stock market. 16% in VTIAX. Is that international? Yeah. 16% international, and then he's got 20% in bonds. I'm maxing out the 401k in my new job entirely into VWENX. Is that merging? Oh, that's Wellington. Huh. Reasonable or not? Well, the 3-fund portfolio, that's what you got. I like that portfolio. We've talked about it many times. Seems reasonable to me. I don't know your age. I mean, there's a whole host of other factors. How much debt do you have? Are you married or not? What does your spouse have? Do you expect to inherit any money? How's your health? Right? I mean, there's countless things that might go into what actually would be the ideal. But just speaking sort of generically, 3-fund portfolio is great. The Wellington fund, let's talk about the Wellington fund. So I'll pull it up here. I'll show you this in a second. Let me pull it up. Here's the Wellington fund. This is one, by the way, we talked about the Barbell retirement plan. Josh, he talks a lot about this fund. He's a big fan of it. It's been a good fund. We can look at its portfolio. So it is, we looked at it, I think last week, 65% stocks. So it's more conservative, Mike, than your 3-fund portfolio because you have 80% stocks. But okay, that's fine. And I think it's a good sort of single fund. One thing I was looking at, and we can look at it in Vanguard, it's relatively inexpensive, 16 basis points. Its yield, 1.61, fine. I was looking at this in Portfolio Visualizer. Was it here? No. I may have to rerun it again, but it'll just take me a second. Yeah. So let me get rid of all of these. So I'm going to use the investor shares because we get a little more data. And we're going to compare it. Let's compare it to we'll compare it to an S&P 500. We'll say 65, right? And then I don't know. I want to get as much data as I can. I don't know how far back B&D goes. I don't think it goes back as far as I'd like, but let's look at it. Well, this is good. I didn't realize we'd go back that far. So this is from January 1994. So what I'm doing here, the reason I've got 65 and 35 is I kind of want to have the same stock bond allocation as Wellington, right? And that's it. That's the logic. There's not much more to it than that. And we can see we're starting with $10,000, and Wellington wins 132 versus 110. Standard deviations are almost identical. It's outperformed, right? Now, we have to think about the starting time and the end time too. So like we think back here, these funds are almost identical. You can't even see that there's 2 lines there until we get to here. And then it starts to break out. But then look at this, the I'll call it the 2-fund portfolio actually now starts to win. That's the blue line, right? No, I'm sorry. It's the other way around. Make sure. Yeah, the red line is winning, which is the 2-fund portfolio. And then we hit early 2000 and it flips, and now the blue line has won all the way through. That's important to understand. If we come down and look at annual returns, it's this time period that defines everything. In 2000, of course, we know that was the tech bubble bursting, right? The 2-fund portfolio, which again is portfolio number 2, lost 2.3%. Wellington was up 10%. It was up in 01 as well, while the 2-fund portfolio was down. They were both down the next year, but again, Wellington not as much. Those 3 years really defined just about everything. 2008, they were both down pretty much the same. So for example, if we come up here and we say, okay, let's first look at 2000 forward. Wellington should still win because it outperformed significantly in 2000, 2001, 2002. And sure enough, 59 grand is there versus 42. Now, I don't know what this is going to look like, but it's not going to look as Wellington's not going to look as good if we start in 2003. In other words, we skip over 2000, 2001, 2002, much closer. Still outperformed by a little bit, but it's much, much closer. And if we look at the individual years, I mean, it's pretty neck and neck. So anyway, I wanted to show you that. Wellington's done pretty well as a balanced fund. If I were going to invest in a balanced fund, it'd probably be top of my list, I would think. So someone asks, it's for Camp, I'm sure I mispronounced that name. What's your view on VXF and also about investing in China given regulatory issues? Well, let's first talk about China. You know, I have emerging markets and fund, and it includes obviously Chinese companies. We can actually look at the percentage because I use VMAX, which is the Vanguard Emerging Market. So let me just show you how you can do this on your own for whatever funds you're looking at. We go to portfolio here, and then we'll come down to exposure, and you just have to click country. China is 36%. So I have exposure to Chinese companies. My view is, at the end of the day, China is going to do what's best for China. And the economy matters, and business matters. Yeah, there's been some crackdowns lately. I'm not an expert on the politics in China, but I think at the end of the day, they're going to want growth. They're going to want a strong economy, and they're going to do what's needed to make that happen. Will there be bumps along the way? Sure. But I think it's too big and important an economy in our world to ignore. So I have no problems investing in China. In my case, through an emerging market fund. VXF, I have no idea what that is. Oh, it's just the extended market fund. Well, I mean, yeah, so I can show you this. So VXF is the Vanguard extended market. So this would be small and mid cap. We can actually look at the weights. It's a little tilted towards growth. That just may be because of the market today, but obviously a lot of small cap and mid cap. I think it's a great fund. You know, how you use it, you know, and what's the overall allocation in your portfolio. You know, you could say, well, if you have that plus an S&P 500, why not just put everything in VTI, a total stock market? Well, total stock market's not going to give you the exposure to small and mid cap that this fund, VXF, will give you. So I could see this along with an S&P 500, maybe one way to approach the sort of small and mid cap market in the U.S. It's all U.S. Yeah. So again, I think it's a good fund. Really just depends on how you're going to use it in your portfolio. Vinyl says, Rob, if you analyze individual stocks, is that really market timing? No, I can analyze all day long. It's when I buy them. That's market timing. So I don't know where that came from. It's an interesting question. So when I bought Bank of America, bought it in October of last year, I don't view that as market timing. But there is a fine line between market timing and value investing, I think. My take on it was it's trading below its book value. It's got a great brand. Its capital structure is incredibly safe because of all the government regulations and rules coming out of the Great Recession. And so I think it's a great value. I'm going to invest in it. I had no views as to what its price would do at any time. I mean, certainly over the long term, I expected its price to go up, but I didn't know if it was going to happen the next day, the next month, the next year, 5 years from now. No idea. So far, it's worked out very well. I can pull it up. So I wish I could show this larger, but that's okay. So here's Bank of America for 1 year. So I bought it a little bit before that. I don't remember what I paid. I bought it in October. So maybe it was around 25. I can't remember. And it's now roughly, well, it's at 50. 40, it's out 47.66. So it's basically doubled roughly over the last year. I didn't invest in it because I thought that was going to happen. And if someone at the time would have said, well, Rob, you're investing in Bank of America, what do you think the stock's going to do over the next year? My answer would have been, I have no idea. And over the next year, for all I know, I could lose all the gains. That could happen. But I think long-term, I think it's a pretty good investment. Now, today, is it a good investment? Well, I don't think it's as good as it was a year ago because it's more expensive. But I don't think it's market timing, no. I do think right now, there are very few values out there. It's interesting, it's in the comment, this is something I was thinking about. Everything's expensive, right? Real estate, crypto, stocks, bonds. And one question is, well, why is everything expensive? Why isn't there some value somewhere? I think it's because interest rates are low and because we've been flooded with money. Not just in the US, central banks throughout the world, we've just flooded the economy with money in the US, all kinds of crazy stimulus. And I don't mean crazy in the sense it was bad. I understand why we did it. Who knows? If I were, God forbid, if I were in charge, I might have done the same thing. I don't know. But we flooded the economies with cash. What's interesting to me is that when you get someone who is a big bull on something, they're bullish on crypto, and you ask them why, they're going to give you a narrative. What's the narrative? Well, it depends who you ask, but it could be, well, fiat. I always like to call the dollar fiat. Fiat is, it's not backed by anything. The government's printing it like nobody's business. There's inflation. Crypto takes the middleman out. Right? There's no bank in between. You don't have to have a Fed. We can transact on our own. It's cool technology. It's the future. Now, here's the thing. All of that could be true, and frankly, as I think about it, probably all of that is true. Right? Now, let's take the QQQ. What would be the narrative? It's tech. It's high tech. This is the future. This is where capital is being invested, and particularly now with the pandemic, and people are working remotely, and it's just even more tech. All true. We could do the narrative. We could go right down the line. We could have a narrative explaining why we're excited about a given asset class, even though the price is high. The problem is none of that narrative, even if it's 100% true, says that Bitcoin should be trading at, I don't know, what's Bitcoin trading at today? I have no idea. According to Mr. Google, it's 65,000. All right. Even if everything I said about crypto is true, and I kind of think it is, why is a Bitcoin worth 65,000? How do we translate the narrative into 65,000? Or how do we translate the narrative about cars into a share price of $1,067 for Tesla with a PE of, I don't know if this is forward or not, 350, right? The narrative could be right, and it could still be overvalued. And so, to me, the reason all of these things are overvalued are not because of the narratives we hear about each one. You can say positive things about crypto all day long. The reason it's overvalued is because we've got a ton of cash to spend right now, and interest rates are low. So we've got cheap leverage and lots of cash, and it's just going where it goes. Cryptos, real estate, the QQQ, stocks, bonds, whatever. So, yeah, I don't even know what started all of that rant, but that's my take on it. And by the way, when money is not so cheap and not so freely distributed, it's all going to come down. Nothing will be spared. Matt, it says all my new money is going into equities with no money into bonds. How about new money into bond snow? I don't know what that means. You're gonna have to clarify that question. Yash says, Wall Street Journal came out with an article showing that most wealthy millennials are self-investing rather than using advisors and mutual funds. Do you think this is a good idea? Well, I think it's a perfectly good idea not to use an advisor, at least to manage your assets. You can get advice on a flat rate basis, hourly basis. You can have them look at your portfolio, talk to you about insurance, your retirement plan. There's no reason to give away 1% of your wealth each and every year for the rest of your life. We don't buy anything like that, right? It's like maybe I should start charging for people to watch my YouTube videos. I probably wouldn't get many views. What if I said, you got to give me 50 basis points? I want 50 bips every year. But seriously, I mean, we go to a doctor. What if they, well, we're just going to charge you 1% of your wealth every year? It's ridiculous. The concern I have, Yash, is how the millennials are investing, and that's one of the reasons I don't promote Robinhood. So I have a ton of companies come to me that want me to promote their services. Some I do because I like them. M1 Finance. I'll probably at some point promote Betterment. I like Betterment. If I might promote Vanguard, I like Vanguard. But I turn down probably 9 out of 10. One of them that I don't promote is Robinhood. And it's because I think they're promoting a kind of investing that I don't think is good in the long term for folks. Investing on margin, crypto, gold, options. They're gamifying it in a way that I think a lot of people are going to get hurt at some point. So I have some concerns. All I can do is keep putting out YouTube videos. This is from Rect. What do you think about IPO stocks? So I've never bought into an IPO. Generally, I don't find the best time to buy. It would be unusual for me to think that the best time that I could buy just happens to coincide with an IPO. I know there's and there's a lot of times there's fanfare. Let's get in quick before the price goes up. Maybe it does. Obviously, you can look at plenty of IPOs going back in time, and if you'd invested, if not at the IPO level, like thereafter, you could have made a fortune. But I don't think that kind of hindsight analysis is helpful. So I don't generally rush. I've never sort of bought an IPO. So a person who is saving for his first apartment, I guess to buy one, or I'm not sure if it's to buy or what, and planning to buy within 2 to 5 years, where should you park your cash? That's a tough question, Alex. I mean, if you're going to spend it in 2 to 5 years, my rule of thumb is I'm not going to put it in stocks. Could you put it in an intermediate term bond fund? Yeah, I'd probably feel okay about that, recognizing that you can lose money. We can even look at that for a minute. Let's see here. Yeah, we can look at it right here. So this was something else I was looking at, but you can see intermediate term treasuries, which are right here. It's the second one. So it's the red bar. And here's how intermediate term treasuries have performed since 1972. Again, it's the red bar. They were down this year. What was that? 1994 by 4%, 99 by 3.5%. 2009 by 1.69. So they've been down. They're down so far this year, 2.45%. So certainly over a 5-year period, I'm going to go out on a limb and say they've never been down over a 5-year period. So you could put them there. There's the interest rate risk. Honestly, right now for short-term savings, there aren't a lot of options. So if I know I needed the money, I'm probably putting it in cash, maybe some treasury bond funds, maybe some tips. That's about it for me. Mike says he recently saw another YouTube finance channel and they suggested an 80-20 portfolio, but it was total market, right? So like a VTI, and then a long FIX fixed position. Let me pull that up. Make sure I know what he's talking about. I read that wrong in my mind. And in the event, could be potentially better than a 60-40 portfolio. I don't know, Mike, do you have specific funds I can look at? You can drop that in the chat. I'll take a look at it. Man, I think I'm getting near the end. Maybe I'm not. I thought I was, and now a whole bit of chat just opened up. Man, I'm not even close. Man, wow. What? Okay. I'm having to hide some chats because people are idiots. Anyway, oh, man, I'm not even close. And it's 1 o'clock. These are great questions, but I'm not going to be able to get to them all, I'm afraid. I will go back and review the chat and add questions to next week. But at 1 o'clock, I mean, I'm going to do a few chess puzzles because there's some of you that like it. But you ask great questions, but I'm going to have to speed up. I think next week what I'll do is I'll only do questions from the chat. So you can email me stuff if you want, but next week it's just going to be the chat. And I'll look through this chat after the video is over and add those to next week to the extent that I can or that it makes sense. So I'm sorry if I didn't get to your question. I see one person, Salty, says, when you made partner, did you get a window office? Did they give you one before you left? Well, Salty, I had a window office my first year as an associate. That wasn't anything special. It's just what they did. I was very uncomfortable because I had a secretary too. And I shared a secretary, like 3 lawyers or something. And, I'm a simple guy from Ohio. It was just weird. It's like, what am I doing in this office and with the secretary? How does this work? Anyway, let's look at some chess puzzles. I feel bad that I didn't get to all these questions. But I will look at them next week, I promise, and focus just on the chat. Next week, it's all you guys. It's all the chat. But it is one, and I'm exhausted. So which means, by the way, that when we do some of these chess puzzles, and I know some of you drop off at this point, that's okay. When we do some of these chess puzzles, I'm going to be pretty tired. Here's the first one. So I thought I would walk through my thinking on these a little bit, for you folks that like chess. So the first thing to know, so it's black to move. The knight has just moved here from this square. How does black win this? Well, obviously, if black can win the knight, then a rook and a king can pretty easily checkmate a lone king, right? So I either have to win that knight, right, or checkmate the king even with the knight on the board. But given the position of the kings, it's just not going to happen. Normally, the way you checkmate a side with a king and a rook is I would get my king to like this square, and then the rook would come over to this square, and the king can't go anywhere. So normally, the way to win the knight is to get in a position like if the knight were down along the same rank or file potentially, but like if the knight were here at d5 and I could move my rook to, let's say, a5, it pins the knight to the king, and I'm going to win it on the next move. So in this position, what I would be looking at is, can I move my rook either to d2 or b3, which of course will force the knight to move. But can I force it to move it in such a way that I could trap it? And by trap it, mean either put it in a position where it can't move, or put it in a position where it's got to end up in a way that I can pin it against the king or whatever. I hope that makes sense. So I would first look at these two moves, and it gets kind of tricky because you have to start looking at all the places the knight can go. So if I move rook to d2, the knight can go, well, it can go to d1, but I just take it. So it can go here to c4 or a4, and presumably I'm going to move my rook to the file, either the C or the A file, depending on where it goes, and try to get it to move again. But really what I'm trying to do is get it to move down to the 5th rank, but I don't think I can force that. So let me stop talking for a second and think. So the other idea I'm having is if I actually move my rook here, the thought is the king is now stuck on this H file, and I can start moving my king up to threaten checkmate. And the knight's going to have to move to save it. And I could potentially win the knight, because I don't think moving here or here is going to allow me to trap the knight. That's just my instinct. I can't possibly calculate all of the possible moves. So one option is here, make the knight move, and then take the G file. Or I could just take it right away. I'm sure there's a difference. I don't know what it is, but then eventually move my king up the board to try to create mating threats against the white king. All the while being careful not to get my rook and king in a position where the knight can fork them. And I can win, and he wins my rook, and then it's a draw, because a king and a knight can't checkmate a king. That's my take. Is anyone still watching? We're down to 153. I get it. Let's see if I've got any moves. No one has proposed a move. Yeah, this is a tricky one. So I don't think I can trap the knight. So the question is, do I want to force the knight to move right away, or do I want to just come right over here to the G file? That's my hunch. I don't know. This is a tough one. That was my choice. I got it wrong. Let's see if my thinking was even right. It was not. So I don't know. We're going to just get the answer. See, I would have never thought of that. I don't even know the logic of that move. Well, I see the logic. The knight can't move. The knight's trapped. But I'm still not sure how I get to a winning position, right? The knight can't move here, 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 or here, or I take it with the rook. I just don't, I see. Maybe this is it. Yeah. So that's pretty good. This is a good puzzle. The point being, here's the point. They move knight there. Let's not do that. Let's come back. Let's assume. See, that's the problem now. The knight can't move, so now the king's got to. The king can't go here, obviously, or here. So let's say he goes here. I'm just going to march right in. Now he could go here, but yeah, I have to think about that. Maybe I don't march in so fast. Let me go back for a second. I want to, let's say he goes here. Okay, king c6. That's interesting. Well, d5 is just as good, and so it's. Let's just go there. King f5, fine. King c6. King e5, okay. King c5, now the king's got to go away. e6. King b4. Why king f5? Let's go king e5. And then, oh, I see, then king c3. Yeah. That's a tough one. Is anyone still watching? 146 of you. That was tough. That's a good thing to know, though. All right, well, my rating went down, so that's not good. Hopefully this one's easier. So when I look at these puzzles like this, black, 2 rooks basically equal a queen. Depends on the position, but material-wise, a rook is generally more valuable than a bishop. So white has a slight material edge there, but black has 5 pawns to 3. When I look at this position, I think, how can I checkmate the king somehow? I also note that my bishop is pinned to my king. I can't move it right now. My first thought is I can move here. The king can't go there, or I push and check and win the rook, but the king can go here. If I go rook down to here, you can just pop up here. I'm not sure that's all that great. You know, maybe this is just trying to get a draw, because I can check the king along here. I guess eventually he could interpose the rook, though. I wonder if this is trying to get a draw. See, I don't think this is the move, because he just comes here. Or here, threatening this rook. Yes, I can check. He just takes the rook. Oh, maybe that does work. Rook here, he comes here, I check, he takes this rook, I take this rook, he can't stop the queen. Well, he can, but he will lose his queen. Yes. Oh, he took it that way. Yeah. All right. Here, let me show you what I was looking at. Here, he could take here, right? But then I just take here. And the only way to stop the queen, pawn from promoting would be like, say, there. But I queen anyway, win his queen, obviously winning. All right, we're 1 for 1. How'd you guys do? All right. So again, when I look at this, I think mating threat, right? I mean, how do we checkmate the king? I don't think, by the way, like bishop takes rook. You know, a rook is generally more valuable than a bishop, but that could end up being the right move. But my instinct says, no, that's not at all the right move. I want to checkmate black with my queen on G7. And so my first thought is moving the queen here. There's no defense to it directly, right? There's no way for black to move a piece to cover this square. Obviously, the rooks can't do it. Pawns are in the way, king's in the way. The knight can't. So then I look at, well, can black check me, right? That's really the only way. So there's a knight check here. I could take it with the queen, or maybe I could just move my king somewhere where there's no more checks. The queen can take here, but I just take it with the rook, so that doesn't seem feasible. So I mean, that's what I would do. Oh, see, look, this is the story of my life. This is what I do in an over-the-board game. I overlook an obvious move. It didn't mean this move was wrong. It wasn't. It was correct. But boy, I should have seen that, right? And so now the question is, what do I do? I obviously don't want to move my king here because he has checkmate in one move. I'm thinking what I want to do is just move my king here because he has no checks. Well, he could check with the queen, but I just win the queen. One way to knights jump around, it can get confusing, but one thing to remember is if whatever color square the knight's on, when it moves, it's going to attack squares of the same color. So it's on white. So any move it makes will be an attack on white squares. Whoops, I did not mean to do that. That's funny because I would not have made that move. And now I can win the queen. I mistakenly got that one right as I was trying to explain this, because what I was going to do was go here. Why is that wrong? Oh, because he's got the check here. See, I overlooked the check again. So he went here. What if he just goes here? Then I just end up hiding. Yeah. So I got that one wrong by mistake, right by mistake. What are you going to do? I'll try better. So again, we're going to checkmate this king somehow. And I've got, white's about to queen the pawn here. That's the problem. So how do we deal with that? Well, why isn't it just queen down check and then rook check? What am I missing? Oh, I'm in check. See, there you go. That's what I'm missing. I'm in check. By the way, in an over-the-board game, I don't normally overlook the fact that I'm in check. I got that going for me. And by the way, in an over-the-board game, you never announce check. That's considered rude. In my case, maybe apparently my opponent should announce check because occasionally I don't notice these things. I hate these puzzles because they're always, where do you move your king? And my first thought is to try to move it somewhere where I can't be put in check. But that's probably nowhere. I'm wondering if I want to go this way with my king. Yeah, obviously can take the rook. I mean, nothing I can do about that. Of course, I can recapture with my rook. Although not if I end up here. That would be bad. That would be a problem. Here, though, I could interpose my queen. I mean, right now I'm up a rook. Obviously, I'm going to lose that, potentially, depending on what happens. I can't do that. I'm down too many pawns. All right, I'm looking for the chat. What do we got? Nothing? Nothing. Queen F1. That must have been a different puzzle. Oh no, that was me trying to do that, but I can't because I'm in check. Yeah, you saw the same thing. Mate in two. Yep, I had to move something. Is this the, no, it's not. Interesting. So what do you do? Go here? No. I assume you take. No, you don't. You check. Oh, of course you check. Then you take. I don't even understand that puzzle. I guess you have to take the rook because otherwise you got mate on h8. Oh, okay, I'm going to do one more. I'm clearly tired. This is smarter than I am. I'm thinking we push that pawn out of the way. When I look at this, but he goes here, I come down here, check. He comes around here. I don't have a check here. I can come back with my queen. He just goes back in front of that pawn. This pawn is kind of a pain. If I get this pawn here, that might give me some mating threats, and he has no checks at the moment. That's what I'm going to do. Wrong. Well, my other thought was this, and that's wrong. My third move was that. My third move was correct. I looked at this move. I just didn't see a good follow-up. I can check him here. Oh, see, this is where I missed that. That doesn't seem that hard. Of course, what do I do now? Boy, this is tough. There it is, threatening down in the corner. I don't know. We can't end on that. We can't end on that. We can do this. All right. So I'm thinking queen here, king goes up, followed by rook here. White still can't take here because the queen's covering it. No other checks. I'm threatening rook here in the corner, forcing the king out, and I got to be able to checkmate somehow. Well, the first one's right. It's the second one that's tricky. I thought about taking this pawn, attacks the rook, but that can't be right. Well, it could be. Who am I to say it can't be right? I don't think I've gotten one of these right. Well, now I just take the rook, right? I could check. He goes there, I go there, he goes there. No, I think I take it. Yeah. Whew. All right, we got one right. Well, at first I wanted to do this, because if he takes the queen, I can then take the knight check, but he won't. He'll just take with the bishop, protecting his queen. So that doesn't do me any good. And the next thought was, well, why don't I just push the pawn? If he takes, I can take back. If he takes with the knight, I take back, he takes with the bishop. Yeah, I just lose a pawn. Wait, no, I don't. What am I saying? And it's wrong. It's wrong. Oh, wait a minute. Yeah, now I see it. Yeah, you trapped the queen. All right. So now what I want to do is get the king away from the queen so I can win the queen. Of course, I'm trapped. I'm, pinned at the moment. So that's not good. This puzzle looks familiar to me. So this is one move, and this is another. I gotta believe I'm taking this pawn because nothing else I can interpose the rook, depending on where the king moves. He moves there, so I can't put the rook here now. I'd lose it, but I can come over here and check him. I got that going for me. And I got like a gazillion pawns, so can't I just go there? There we go. All right. We're still over 2,800. I want to get to 3,000. I don't think that's ever going to happen, is it? Oh, come on, Rob. Don't be a negative Nelly. Well, I can win that knight. I see that, right? Because eventually this pawn has to take it. My rook can slide down. It's checkmate. He takes it right away. The queen interposes, but then I can check the king here with the bishop. The king moves. I can win the queen. So I think that's right. Boop. Boop. Some of these I get pretty quick. Oh, wait a minute. We're not done. Great. Well, I guess I just take the rook. All right. Did you guys get that one? You guys keeping up? Is anyone even watching? Oh, I see you. You're there. Oh, I love these. Pawn end games are fun. So my hunch without any analysis is this is the answer. Although the king is pretty close. The point is you can get a passed pawn. Although, as I think about it, the white king is pretty close. Oh no, he's not close enough. So if I push here, he takes. I think the trick is so if I push here, I think he's going to take. The trick though, I think is I don't want to take here because that puts the queening square, which is here, closer to the king. I want to push. Obviously, if he takes, I take back. But can he still get within the square? I think he can because he moves there. I go here. He can. So now having my doubts, I'm wondering if I should take this. He'll take back. I push. No, I go here. If he goes here, I push, and he's forced now to move the king, and I'm going to get one of these two squares. That's my best guess. Chess is exhausting. Okay, the first move I got right. I don't think I move here yet because, oh no, I do. The problem is if I move here, he can just move here and wait for me. I think, yeah, okay. I thought that was the move. Okay. There we go. That makes sense? By the way, if those of you who've joined late, I do 2 hours of finance questions, and then we do chess puzzles. That's the show. And I'm going to be hanging up soon because I got to go. But you can watch it. I'll have timestamps on everything. By the end of the day. And for those folks that ask questions in the chat I didn't get to, as I promised, I'm going to look through the chat, collect a bunch of questions. We'll cover them next week. We'll do one more puzzle. Hopefully we can go out on a strong note. Well, I can take that bishop with check. That seems like a decent move. And then check him. He goes to d7, take the f7 pawn, and he's got to go back to the first rank. Probably c8. If he goes to d8, I can check on e7. And then I check him on knight d6. I think so. I think. Okay, well, now this is interesting. I could win the knight, but I'd be down the exchange. I'm going here. Oh, maybe this is still checkmate somehow. I'm not taking the knight. I can tell you that right now. Nope, it must be here. Then here. Well, you know what? Sometimes you just got to end on a note that's not that great. Well, there you go. Those are the chess puzzles for the day. I clearly need to up my game. Anyway, as I said, I'll get timestamps into the videos, into the video. I won't forget about the questions you asked in the chat. We never got to. I'll look at them next week. It'll be all about the chat, and hopefully can cover them all. And that's what I got for you today. Hope you're having a good day. Hope you enjoyed the show. I'm exhausted. I need a nap. So until next time, remember, apart from a nap, the best thing money can buy is financial freedom. I'm out.